Greetings, everybody. Welcome, Liberty Call. Today is Tuesday, February 13th, 2024. Hope everybody's having a fantastical day out there. It's a beautiful day out here in Colorado. We have a cloudless sky, blue, still way too much snow in my yard. So it's weird. You look across the street and my neighbor's front yard faces south and there's like no snow. You look, if you're standing in the street and you turn and face south and look at my front yard, it's nothing but snow. And it's like this deep. So it's just crazy. So anyways, like I said, hope you're having a great day out there. The markets did not have a great day. The CPI, or the inflation report, did not come in as expected. So markets dropped like a stone. Let me flip through and see. Yeah, there's red everywhere. So it's a mess out there. So, all right. Well, if it is your first time watching Liberty Call, I'm glad you are here. You're one of 4 or 5 people who actually watch this. So if you could do me a favor, could you give me some thumbs up, like, share, subscribe, follows, press that notification bell. Hey, and send this to a friend. They may be like wondering what the hell's going on in the world. So, I'm here to help. All right, let's go ahead and get into today's numbers. Dow Jones down 1.35%, 524 points. It was down over 700 at one point. Closed at 38,272. The S&P 500 down 1 1/3. Closed at 49.54. Nasdaq down 1.8%. Closed at 15,655. The VIX was up today 13.78%. It's at 1585 right now. Canada down 2.29%, Brazil down 0.15%, and Mexico down 0.88%. In Europe, Germany was down 0.95%, the UK down 0.81%, France down 0.84%, the Netherlands down 1.43%, Spain down 0.59%, Italy down 1.03%, and I lost my spot. Switzerland down 1/3, and Portugal down 0.97%. In Russia, both exchanges were green today. The MOEX up 0.17, the RTSI up 0.2. And the Asian markets, the Nikkei was up 2.97%. Australia down 0.15%, and New Zealand down 0.13%. And all the Chinese markets are still closed for, I believe, is it the Lunar New Year? I'm not up to date on all my holidays around the globe, so I think it's the Lunar New Year if memory serves me. All right, let's go ahead and move over to the market recap. Dow slumps as Treasury yields jump after hot inflation report cools rate cut bets. All right, on Tuesday, the Dow Jones Industrial Average experienced a downturn fueled by a surge in Treasury yields following a higher than anticipated inflation report, dampening hopes for an expedited and aggressive Federal Reserve rate cutting strategy. Again, I've been saying this for months now. I do not expect the Fed to cut rates unless something terrible happens. Now, a market drop, of like 5 or 10%, that might actually, well, probably more than 10%. You'd want to have some sort of a correction or something that they could actually point to. 5%, I don't know if they'd actually jump at that. The U.S. saw headline annual inflation slow slightly to a pace of 3.1% in January, down from 3.4% the previous month, although still surpassing economists' forecasts of 2.9%. Core inflation, excluding the volatile elements of food and fuel, because no one ever eats or drives, maintained its annual pace of 3.9% from December, defying expectations of a slowdown to 3.7%. This unexpected inflationary pressure led to significant jumps in Treasury yields, with the 2-year yield rising by 17 basis points to 4.637% and the 10-year yield surging by 14 basis points to 4.316%. Analysts attributed the inflationary uptick to various factors, including a notable increase in shelter rent costs, signaling broader signs of inflation resurgence amid a robust labor market. Consequently, expectations for Fed rate cuts diminished, with the likelihood of a rate cut in March nearly discounted and the probability of a May rate cut dropping to 31.6%. And I read in one of the articles I was reading earlier today that, it might be September. It was one of the Fed presidents talking that maybe September before they even consider any rate cuts, at this rate, if inflation stays the way it is. Amidst market turbulence, Coca-Cola reported better than expected fourth quarter results, but faced concerns over weakening pricing power, leading to a nearly 1% decline in its stock. Biogen and Hasbro both stumbled after reporting lower than expected profits and revenues attributed to competitive pressures and operational challenges. However, Nvidia managed to weather the storm, trading near steady levels despite the broader market decline, following a price target upgrade from Mizuho to $825 from $625. The chipmaker's resilience was supported by expectations of continued market dominance amidst rising demand for artificial intelligence. As Nvidia prepares to unveil its fourth quarter results on February 21st, investors remain cautiously optimistic considering its impressive 231% surge over the past year and a substantial market capitalization of approximately $1.79 trillion. Yeah, I'd be careful with the AI stocks. I've read multiple articles about the overvaluedness of the tech sector, and you certainly don't want to be holding a hot potato when everything starts to fall apart, because you're gonna be like, and it's going to drop like a stone. Alrighty, next up, got the CPI report here from First Trust. I'm just going to read this verbatim because these guys are a hell of a lot smarter than I am. So, all right, see what the bullet points were. The CPI rose by 0.3% in January, above the consensus expected 0.2%, and it's up 3.1% from a year ago. Food prices rose 0.4% in January, while energy prices declined by 0.9%. The core CPI, which excludes those two, rose by 0.4% in January, above the consensus of 0.3%, and core prices are up 3.9% versus a year ago. So basically 4%, or basically double what the Fed is okay with as far as inflation, because they're, if inflation's 2%, they're cool with that. They don't mind. All right. Real average hourly earnings. The cash earnings of all workers adjusted for inflation rose 0.3% in January and are up 1.5% in the past year. Real average weekly earnings are down 0.1% in the past year. All right. So what are the implications? Inflation accelerated at the start of the year, showing that it is still an important problem, and the Federal Reserve should not rush into cutting rates. Yes, the M2 measure of money is down in the past year, but the aggregate may not be directly comparable to history, and even if so, the lags are long and variable. Consumer prices rose 0.3% in January, the most in 4 months, and above the consensus of the expected 0.2%. In the past year, overall consumer prices are up 3.1%, still a far cry from the Fed's 2% target. Notably, headline inflation was held down in January by the volatile energy sector, where prices declined by 0.9%, in large part due to a 3.3% drop in gasoline prices. Stripping this category out along with food prices shows that core inflation accelerated in January as well, increasing 0.4%, the fastest rate in 9 months, while the 12-month comparison remains stubbornly at 3.9%. Looking at the details, rental inflation for both actual tenants and imputed rental values of owner-occupied homes continued to defy predictions of imminent reversal, rising 0.5% for the month and still running at or above 5% annualized rate over 3, 6, and 12-month timeframes. This is important because housing rents make up a third of the overall index and accounted for more than half of the monthly rise in January. But the most troublesome piece of today's report came from the movement in a subset category of prices that the Fed is closely watching, known as the supercore, which excludes food, energy, other goods, and housing rents, and is a useful gauge of inflation in the services sector. This measure jumped 0.8% in January, the biggest increase since April of 22, when the U.S. was experiencing the height of inflation of its inflation scare. In the last 12 months, this measure is up 4.4% and has been accelerating as of late, up 6.7% and 5.5% annualized rates in the last 3 and 6 months, respectively, stoking fear that inflation has become entrenched in the services sector. The spike in supercore prices in January was largely due to increasing prices for transportation services, 1%, medical services, 0.7%, and hotels, motels, 2.4%. Meanwhile, the U.S. economy and labor market continue to chug along, no matter which way you cut it. The Federal Reserve has little reason at this point to start cutting rates anytime soon. How they respond to the incoming economic data in the months ahead could determine whether we repeat the inflationary 1970s. And I was a little tight at the time, but I still have quite a lot of memories of the kind of just stagnation that was across the economy. And I don't think we want any of that. We do not want high inflation and stagnant wages and just a malaise over the economy that we had in the 70s. And, a lot of people will point to Reagan and Volcker and say, well, look what they did. I mean, and Volcker, in my opinion, took the right course of action by raising rates up into the high teens. It nearly crippled the economy for a short period of time, but it basically reset everything. And, we had, 2 decades of pretty solid, just overall prosperity in the U.S. economy, from the mid 80s to, I'd say, the early part of the 2000s. And then we had the .com and all the money printing of the housing crisis, which, we've been the last, 15, 20 years dealing with that problem. So, all right. Last up, got one more article here. Comes from Zero Hedge. It's titled "The Fed is very concerned over spending and interest on the national debt." And this comes from Mike Shedlock via mishtalk.com. All right, let's see what he had to say. The report from the San Francisco Federal Reserve raises significant concerns about the long-term fiscal outlook of the United States, particularly regarding escalating congressional spending, the sustainability of Social Security and Medicare, and the mounting interest on the national debt, with federal debt now equivalent to the country's annual GDP. The risk of higher borrowing costs and increased long-term interest rates looms large, potentially impeding investment and economic growth. Drawing parallels between the current era and the post-World War II period, and the report highlights the historical context between the debt to GDP ratio and primary deficits. While the primary deficit surged during World War II and the recent pandemic, the projected increase in the debt to GDP ratio over the next 3 decades could pose significant challenges. Unlike the post-World War II period, where economic growth outpaced interest rates, the current trajectory suggests a sustained rise in debt relative to GDP. The report underscores the importance of addressing mandatory spending programs like Social Security and Medicare, they're going to go away real soon, which are projected to exert substantial pressure on the primary deficit in the coming years. Without significant reforms or revenue increases, the primary deficit is expected to persist, leaving economic growth rates versus interest rates as critical determinants of debt to GDP ratio's trajectory. However, the projections rely on relatively low estimates of GDP growth, raising concerns about the feasibility of sustaining current fiscal policies. While technological advancements like artificial intelligence could potentially boost productivity and mitigate economic challenges, they may not be sufficient to offset escalating government spending. Additionally, dependence on foreign demand for U.S. treasuries to alleviate debt pressures may not be a reliable strategy. In light of the report's findings, both political parties face the imperative of addressing fiscal sustainability, yet the divergence in policy approaches between Republicans and Democrats complicates the path forward. While President Trump and President Biden have pledged to protect Social Security and Medicare, the report warns that doing nothing risks automatic cuts to beneficiaries, highlighting the urgency of bipartisan action to avert a fiscal crisis. Well, maybe if we didn't, spend $1 trillion on military spending and foreign aid and all that good stuff, and didn't have all these federal agencies, which are, in my opinion, unconstitutional because they're outside the scope of the federal government. But hey, most fools in this country think the federal government is supreme to everything. So, but if we say cut the spending by, 2/3, we'd have plenty of money to take care of the aged, take care of the sick that can't take care of themselves. I have no problem doing that as long as we're not wasting the money. And I have a say in the matter. Anyways, all right. Well, that's that's what's going on in the world today. We got too much debt, inflation's still running too high, and the market didn't really like it. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios. Wrong button.